Hello, everybody, and welcome. Thank you for joining us. I'm Monica Miller, Portfolio Manager and Partner of our Private Assets. I'm joined by our Investment Committee, made up of Ian McLeod, Catherine Woodman, and Shane Johnston, who are all principal advisors at our firm. Just a quick compliance disclosure on the next page. And our compliance disclosure is saying that nothing is promissory that we discussed today, and nothing constitutes investment advice. We avoid naming individual companies to reduce the chance of misrepresentation, and past performance is no guarantee of future returns. Next slide. Today we're going to be covering, we'll do a brief introduction of our ESG models and how they performed in Q2. We'll talk about our impact, and we'll talk about our strategy going forward. And then after the recording is stopped, we'll end the recording there, and then we'll answer any questions. And I also want to mention before I hand off to Shane that I'll be also doing a presentation next week for our private fund, our high impact fund, which will be closing September 1st. We've been working on that fund for the last 3 years. So if you're interested in placing capital there, it's for our qualified clients. And if you want to attend, we'll give an update on the fund and have a guest speaker from one of our pipeline investments. So with that, I'll hand it over to Shane.
Great, thanks, Monica. All right, as a way of introducing the model, I just want to acknowledge first our investment committee. Each of us has been managing socially responsible investment portfolios for 2 decades. Each account that we manage for our clients is assigned to a particular model. And we work together as investment committee to decide the asset allocation within those models, as well as individual securities within each of the models. And I just want to remind you, so speaking of models, we've got here 8 different asset allocations. Each one is what we call a model allocation. And although we've got 8 basic model allocations, we've got different ways that we can fill those allocations. We could use individual securities, or we can use mutual funds and ETFs. And the distinction between those two is largely driven by the size of the account, not always. So for larger accounts, we're often using individual securities, and that gives us a chance to do some customization for taxes or for impact. And historically, we've measured our individual stock portfolio performance against the S&P 500. But as you can see from this slide, our stock model cap weighting or its asset allocation within the individual stock model is only about 31% large cap US stocks, which would be comparable to the S&P 500. We've got 30% in mid-size US stocks, 13% in small company stocks domiciled in the US, and then 24% that are international stocks. So comparing it to the S&P 500 is a little bit apples to oranges. And so today we've got the performance year to date against the S&P 400 mid-cap index. And you can see that year to date, our stock model has performed a little bit closer to a mid-cap index with a lot less volatility. And on the next slide, we've got the model over various time periods for different risk tolerances. So up at the top here, we've got the all stock model year to date up 8%, and over the 3-year up 21%. And down at the bottom, we have some major indexes that we compare the performance against. And the S&P 500, as I already mentioned, is a large cap index, US. The EFI is an international index. Dow Jones Industrial Average is a stock model index for US companies. and the S&P Midcap 400 index, which we just saw on the graph. And there's some discrepancies on the graph and on the chart. I just want to mention, and I think we've mentioned this in the past, about how we measure performance and how anybody is measuring and reporting performance, that there's different techniques. It's part of why we have to have all the disclosures. Three of these four that I've mentioned, not the one on the bottom, which is a bond index, they're all stock market indexes. So when we talk about comparing stock performance, it's really important that we get the apples to apples correct, and then it's clear. But at the end of the day, our asset allocation, we move to the next slide, Ian, our asset allocation is very intentional, and we have an investment philosophy around our stock model. We are long-term global investors looking across all sectors equally to find profitable companies that are leading their industries toward a sustainable and just economy. We can get more into what that means in a future presentation, but Catherine's going to talk a little bit about our model asset allocation performance using funds and ETFs.
So yes, talking about our mutual fund and ETF models, looking at the performance year to date and over the 1 year and 3 year, what a difference a quarter makes. So the market has continued, both the bond markets and stock markets have continued to keep recovering since October, basically. So while a lot of these numbers were in the negative when we did this last quarter, most of them are in the positive, except for sort of longer term bonds. You can see down there at the bottom corner. But otherwise, everything has kind of been on a recovery trajectory, which is interesting. And as for what is to come, that is kind of the big question. Let's go ahead and go to the next slide. So this is looking at our mutual fund models. Basically, the green line is our most conservative model. The blue line is our balanced model, which is kind of right in the middle. And the lighter blue line, the lavender line, let's say, is down there at the bottom. That's really close to the S&P 500. So what's interesting about this, a couple things. One is that the models are doing what they're supposed to be doing. So the most conservative model didn't go down nearly as far as the stock market did. And so it has it needs less upswing to get back to neutral. So I wanted to show this just because, especially if you're looking at year to date and really just looking at sort of partway into a recovery to now, you're going to look at the capital preservation model and say, oh, it's not doing as well. But that's because it didn't fall as far. So it doesn't have to come back quite as much. And you can see that the more aggressive model is really tracking pretty closely to the S&P 500. And that's interesting given what Shane was just talking about, our individual stock model, which is much more of an all cap global fund. Even the socially responsible ETFs and mutual funds that we're using, even with the variety of funds that we're using, once you get enough of a percentage of the model that's in those, you're really tracking the S&P pretty closely. And that's mostly because every single fund is keying off of that index and is trying to either do as well or slightly beat that index. And so for me, I feel like what we're doing with the individual stock model is being not so tied so closely to that and being judged so closely to that. And so we have a potential for, I think, greater actual diversification than people that are sticking to that index, because usually there's like 5 stocks that you need to have in order to be in that in that index or be tracking it fairly closely. And some of them are problematic and some of them aren't, but it's nice to just have a little bit more freedom to really choose based on ESG. So I think that's enough for that one. The next slide. So I wanted to talk a little bit about the broader economy. So most of the news that I've been hearing has been mostly positive. Inflation was down to 3% for June, which was down from over 9% last year. So that means what the Fed has been doing has been working. The Fed working to lower inflation has been working. they've been saying that they're going to raise interest rates likely 2 more times this year, but maybe they won't need to if inflation does come down and kind of stay down. The other news, unemployment is still relatively low. It hasn't suddenly shifted up a lot. So a lot of the news coming out about the broader economy has been fairly positive. This is something that's actually discussing sort of the opposite side of that. This is from the Conference Board. And you can get this really easily by just Googling Conference Board LEI, which is leading economic index. So they track both the leading, the coincident, and the lagging economic indices. So it can be just interesting to take a look at where they're saying we are in the business cycle. And just to say where they say that we're at, they've said that basically in July, the leading economic indicators declined for a 5th consecutive month, suggesting that recession risks are rising in the near term. That consumer pessimism and the equity market volatility, as well as slowing labor markets, housing construction, and manufacturing, suggest that economic weakness will intensify and spread more broadly throughout the U.S. economy, and that this could tip us into recession, into a short but mild recession by the end of the year. So, I mean, it's interesting because I do ask both within our investment committee and more broadly what people think. I'm actually fairly neutral about what is going to happen, not meaning that I think it's going to be flat, but like I think that it's a little bit difficult to predict at this point because the stock market has come down, PEs have come down. There's a lot of things that just seem more reasonable at this point. So we'll see whether this actually translates into further market corrections in either the stock or the bond markets, or if maybe we've already sort of taken enough of a hit that we don't have to take a further hit. I don't know. But I kind of wanted to talk also about these indices and how well they are at predicting. So if you go to the next slide. So this is basically looking at these leading economic indicators and what they've indicated to us throughout time. So you see that each of the black little dots, the black lines below the graph, exactly, thank you, are showing warning signs of a recession. So anytime that you see a black line that isn't immediately followed by a red line, that means a recession was predicted. So I've heard it said about a graph like this that 7 out of the last 3 recessions were predicted by following the leading economic indicators. So basically, all to say that we are seeing warning signs of a recession, and whether one will actually appear or whether it won't is not guaranteed by this information. So we'll all find out together. So I'm going to leave it now to Ian to talk a bit about our proxy voting. Thanks, Ian.
Thanks so much, Catherine. And I'm just going to briefly touch on a couple of 2 parts to our how we think about and what we've been doing around the impact of our investments, because that's as big a part of what we do and why we do it as the financial side. So and we've had in the last six or so some months I think some really interesting, led by Chris and Shane are some really interesting updates to our some holdings and such. So I'll just start with a quick note on proxy voting. We as a firm, we began to vote on behalf of clients earlier this year, and proxy voting can be a really useful tool in encouraging, nudging companies, publicly traded companies, to do the right thing. And there are many, I think, cases where they resist that. So proxy voting, using it's one tool, right, among many, to get to nudge companies to treat their workers well, to pollute less, to commit to better policy in the future and now, frankly. So the other thing we do is, as part of our proxy voting, is we partner with an organization called as you sow, and well known in the world of financial services. They're a nonprofit that does like really great research and support for firms like ours. They do a lot of work on their own. We sometimes can partner with them on shareholder resolutions and such. And so we get their recommendation and get some of their research and helping us make decisions on how to vote. And the highlight around in the last really 3 to 6 months has been many votes that we are asked to take are on should this or that accounting firm be approved, or should this or that slate of directors and managers be approved. And overwhelmingly the default sort of management vote is yes, and what they think is in the company's best interest. Sometimes the recommendations we receive and accept are in accordance with the management, but often they're not. And for example, the issue to bring up recently, one highlight quickly, is that there have been some companies the last 3 to 6 months that are being asked to make commitments, not just write reports, but to make commitments on their role, how top to bottom, A to Z, how they can contribute to the just transition framework, right? It's about a just if you have some time, look around for the just transition framework. It's a framework, policy, recommendations, processes to help support companies in moving towards a less carbon intensive future, fossil fuel free world, right? Certainly a long-term project, but the work they do is really positive. So we've been voting. We take the yes vote on when companies come up to and are asked to say whether they'll make commitments and to take actionable steps to moving in that direction. And quickly, I'll just note a couple things. Two profiles of companies that we've added to our models in the last couple of months. Last quarter we removed some of the financial services companies after what is probably not a done financial potential. A lot of turbulence in the world of finance and banks, but so we removed a lot last several months. And this quarter we've been we just look around. We think about ESG and SRI as an ongoing process. So we've added one of the bigger sustainable food companies that, as you can see at the top, speaks to they part of our research in ESG is to think about how a company addresses the UN Sustainable Development Goals, SDGs, and so on this slide and the next one, you'll note what issues are addressed specifically. And so we want certainly for as we renew and reassess companies we hold, companies we don't hold. We look to add companies like this sustainable food company, and I said this next, an energy storage company that's doing a lot of really interesting work in just 5 years around energy storage, clean energy. It's like the depth of the need around both clean energy, sustainable energy is profound. And this is one of, I think, many companies. One we found was really interesting, and we think helpful over the course of the long term for our portfolios. One that addresses interesting and not interesting. That's not the right word, but addresses critical needs around infrastructure and energy storage, which of course snowball into the other needs like mitigating climate change, maybe someday reversing it. Just 2 examples. And so we can't name on this call specific companies, but if any clients were to see, they'll see these companies in their portfolios in the future, but now soon. So I'll pause and
I'm going to talk a little bit about strategy going forward. So in terms of where we're at now, we're in the midst of a rebalance of our portfolios, because you can probably sense my neutrality about, who can really say exactly what the next 6 to 12 months is going to bring. So we haven't made any big bets in terms of stocks versus bonds. So we've kept those percentages the same. But what we have done, because inflation has come down, which generally makes it a less favorable environment for commodities. So we've taken just a sliver away from commodities and added that to gold in our alternatives, because also hypothetically, if a recession is coming, then that could be possibly a time where gold could outperform. Historically, it's been longer term treasuries and gold, and sometimes mortgage-backed securities that have historically been a counterpoint to what stocks have done during a recession. But we shall see. And then the next go around, our next rebalance, I think we're really going to start dipping a toe into more individual bonds. So for clients who do have individual bonds and even ones with bond stocks or bond funds, we might be just going a little bit longer in terms of maturity and looking at intermediate term bonds. So that's going to be, that'll probably be in the next 3 to 6 months of what we do moving forward. And I think Shane's going to talk a little bit about our strategy in terms of individual stocks.
Yeah, I just wanted to mention that right as we speak, over the last couple of weeks and ongoing for the next couple of weeks, clients with individual stocks are going through a rebalance, and we're trimming back. I mean, the market's just gone on a tear this year to date, and we have some positions that have just performed really well, and we're taking this opportunity to trim back some of those gains. And as Ian mentioned, let go of a couple positions. So we're creating, you might notice in your account, we're creating a little bit of cash that will be systematically reinvesting into the market over the next 2 quarters. And I think with that, Catherine, there was one thing we wanted to mention to folks about the Schwab transition.
Right. So just a heads up for those of you at TD Ameritrade, who has been our custodian for the last however many years. They were purchased by Schwab probably 2.5 years ago. So we've known that this is coming, and it is finally coming, which is that our accounts are going to become Schwab accounts at the beginning of September. So no paperwork is needed. You will get a new account number. Our systems will be staying the same. So where you go to get reports and invoices and stuff, that won't be changing. But just keep an eye out, not only for emails from us, but also for emails from TD Ameritrade and Schwab. That's our suggestion for the next few months. And that'll be happening over Labor Day weekends in September. Thanks.
Thanks, Catherine. It's finally happening, huh?
It is finally happening.
Okay, well, we're those who want to stick around, we're going to stop the recording, but those who want to stick around and ask any questions, we're here for that.